Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, how you can collect a premium upfront, and also how you can generate consistent returns year on year. The first thing that we need to do is pull up our brokerage platform. Of course, we're going to be using options. Specifically, we're going to be writing the options contracts. So it would make sense for us to know where we are in the options chain before we start, in the options cycle, sorry. So if we just pull up an underlying anything, let's just say Boeing, and now we've got a table of expiration dates. We've got our weeklies, and then everything else without an orange W is a monthly. We want to be about 45 days out in time. So our next monthly expiration is October 18th, which is 20 days away. It's a little bit too soon for us. So I think we'll go with the November 15th, 48 days out in time. And now that we have that information, 48 days, we can go over to our watch list and we can filter out everything that has earnings over the next 48 days. And the reason for this is because earnings can have a negative effect on your P&L. It can mess up your deltas, increase volatility, and all these things are not good for your position. So we want to avoid earnings, so we filter out every underlying that has earnings over the next 48 days. We can also filter out everything that has a low liquidity level. So what we're left with is a list of very liquid underlyings with no earnings, and all that's left to do is order everything from high IVR to low IVR. The reason for this is we want to sell volatility when it's high, and we want to play the contraction back down to the mean and even further on. So we just go through the list, and whilst we're going through the list and looking for something to trade, you want to keep an eye on what's going on in your portfolio. You want to make sure that you are not too heavy in any one sector. For example, if we had a position on Boeing, we probably wouldn't be looking for a position on, say, LUV. Or, we've got a position on UAL, we wouldn't look for a position on Boeing, or vice versa. So just keep that in mind as you go through the list. And other than that, you just want to see what stands out to you. So we've got FXI with a nice liquidity level. A lot of things seem to be happening in China with Baidu, Baba, FXI now as well. By all means, we could take a look at FXI. It's got a very, very high IV rank of 99.7. If we just take a look at the chart, this would explain it. This is a very similar story to Baba as well. If we just have a look at Baba, very, very similar. This is a position that we were mocking up in a previous video. So yeah, FXI, Baba, Baidu, I mean, it's all pretty much the same trade as of right now. SLV, we've had a look at SLV. Neo is looking quite nice at 76.6. If you have a look at the chart there, Neo came down to recent lows at about $3.75. As you can see, IV isn't the worst, isn't the best. It's kind of in the middle. It has got a high IV rank though at the moment. Let's just keep going down the list. GLD. Let's have a look at GLD. Why not? GLD is trading at about $245 at the moment. We've got an IV rank of 75.2. It's got 4 out of 4 stars on the liquidity level. I think GLD would make for a decent position. Of course, we have already got a position on a GDXJ, but it's okay. This is just for example purposes. So let's just have a look at GLD. So we pull up the list of expirations. We already know we're going to go straight over to the November 15th expiration, which is 48 days out in time. And now we're looking at the options chain. So we've got this orange horizontal bar going across the middle. And this shows you where price currently is with respect to all of the rest of the strikes. As we can see, it's trading at about $245.38, which is right in between 245 and 246. And this vertical orange bar shows you what the expected move of GLD is over the next 48 days. So what we want to do is we need to know what contracts are we gonna write and where are we gonna write them. Whether you say you're gonna write them or whether you say you're gonna sell them, it's the same thing. So we need to know what strikes are we gonna sell our contracts at, and what contracts are we going to sell. There's two types of contracts, calls and puts. We're going to sell one call and one put, and I like to sell them anywhere between a 15 and 20 delta. So if you go to the delta column, we can see here we've got a 15 delta at the 265 strike, and then if you go over to the put side, we've also got a 15 delta here at the 231 strike. So we've got a call contract at 265 and a put contract at 231. Okay, so if we were to mock this up on a chart to see what that looks like, just before we do that, I just want to make a point here. Naturally, if you go with a 16 to 20 delta, more often than not, naturally, you're going to end up at about the one standard deviation mark, and you're most likely going to end up just outside of the expected move, which is perfect because we want to be just outside the expected move, but we don't want to be so far away to where we're not collecting enough premium. So 15 to 20 delta, you can also, double check it with this by looking at where your expected move is. So if we just plot this on the chart, 231 and 265, 231 and 265. So this is what the range would look like. This is our call up here, and this is our put down here. This is the range that we would want price to stay within. As we can see, IV rank is pretty high right now. It would be nice to see a bit of a contraction, see some volatility come out of the market. It is a pretty wide range, and I think overall this is a pretty clean position. And if you don't have any gold positions on already, by all means, you could take a look at this. You would get $7.8 in daily theta decay. You would collect $257 upfront, and your broker is going to require about $3,500 in buying power to open this position. So it's not a bad return on capital trade for a naked position. Naked meaning there's nothing covering your contract. I will explain a little bit more in detail about that in a second. So you collect basically $260 up front. The broker is going to require $3,500 in buying power. It's not a bad return on capital, and we are going to enjoy a high probability of profit of 69% and an 83% chance of hitting 50% of max profit at some point over the next 48 days. So very, very high probabilities there. And if $3,500 was a little bit too much for you and you didn't want to take that much risk on any one position, by all means, you could. This is what I was referring to about a naked position. So this is a naked position. We can now turn this into a covered position and reduce the buying power requirement. The way we do that is by simply just going a little bit further out. So 265 on the call side, we go a little bit further out to say the 270, $5 wide, and we just simply buy that. So we sell the 265, buy the 270, do the same thing on the call side. $5 down from 231 is going to be 226. Just buy that. $5 wide. It's the same thing. $5 on that side, $5 on that side. And if you have a look, our buying power requirement has now dropped all the way down to $400, or just under $400. We still collect $1 in premium, but our buying power has significantly reduced. And what this has done is it has created a higher return on capital trade. Now, if you wanted an even higher return on capital trade, and if you are going to sell a covered position like this, I would actually advise to go a little bit heavier on the delta. Maybe go closer towards a 20 as opposed to the 15. And we just keep that $5 wide. You don't want to increase the width. You want to keep the width the same. So $5 wide on that side, $5 wide on this side, and now we collect more premium and less buying power is required because we lock in our loss with this green contract by buying another contract further out, we lock in the loss, and the loss is limited to whatever the difference is between the two strikes. So in this case, $5, but we collect $1.48 up front. So 5 minus $1.48 is 3.52 or $352. So that's where that comes from. So it doesn't matter what size portfolio you have, this is how you can play GLD over the next 48 days. Now, in addition to all of what we've just gone over, when you are looking for positions, you do need to keep in mind the size of your positions. It doesn't matter what you do or what you know, if the size of your positions is wrong, then eventually it will cause problems for you. So we have this position sizing template. It's free for everyone to use. And the way it works is you enter in the size of your portfolio. Let's say if it's $50,000, right? You then enter in what the current VIX level is. Let's say if it's 25.3. What will then happen is everything below will be automatically calculated for you. And all you need to do at this point is use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to any single undefined risk position, any single defined risk position, and how much of your portfolio you should allocate to short premium strategies in general. So this is free for everyone to use. Click the link in the description and then head on over to the free position sizing template, and it will take you to the spreadsheet. If you want to get involved on the positions that we're placing and you want to make money alongside with us every week, then again, click the link in the description, head over to EDS Premium and get yourself signed up. Inside, you will have access to all of our portfolios, small and large, so there will always be positions for you to copy. There's a full course inside, so no prior knowledge is required. We will teach you everything you need to know, and this allows you to learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money-back guarantee. So if you've studied our full course and followed our trade for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part, and right now it's £1 a month. The price will be increasing. However, once you're in, you don't need to worry about price increases as long as you don't quit and then rejoin back at a later date. So with that being said, I will see you guys on the inside.